Hey guys, this is Einsteina and I've just now joined the new job. So we were having dinner last night with my friends and everyone was talking about what they are up to and what they're planning in their life. Suddenly a guy, he said that he started investing. Like, is it our age of investing or something like that? I don't think so. So the question that kept on daunting me whole night, and I ended up opening my laptop, googling about some of the investment philosophies and everything. And guess what, my question remained unanswered, because all these kind of questions like where to invest, how much to invest, where, they are really confusing to me. So I thought that I must need an expert. So I started searching for an expert online. I found this guy. He is an expert in investment. He can help me out with all my questions, and he's also president of a leading asset management company, DSP Investment Managers. So hi Kalpin, welcome to the portal, and I would like to help me out. I would like you to help me out for some of the investment things because I don't know anything about investment.
So first of all, I envy you because very early in life, this question came to you. Number two, I compliment you that when this doubt came to you, you didn't give up, but you made an effort. You spent some sleepless hours to try and find out more. The business of investing is all about time, and the beauty about getting confused very early in life and seeking answers very early in life will help you start your journey maybe at the age of 25. I'm sorry if I have overstated that number, or maybe at the age of 20, which means you have a long runway for investing. You mentioned that, is it for us? Is this guy stupid who's talking about investing so early? Is this relevant for us? Let me, give you an example of an iconic investor who is almost the richest man on earth. His name is Warren Buffett, and most people idolize him for his good principles of leading life and dealing with money. He is 85, and he's the richest man on earth. And he was not born rich. He was born just like you and me in a middle class family. And he says that his source of becoming rich or having a lot of money is disciplined investing. And his second source was starting early. He started investing at the age of 11. And at age of 11, he was very clear in his life that this is the best way to make money. And at the age of 11, he said that I wish I had started 11 years early. So he is a very powerful example of a principle called compounding. So in school and college, we all learned the principle of compounding, right? When we were doing our maths and calculations. What does the principle of compounding say? It says that the amount of money you make is equal to the amount of money you save multiplied by the rate of return you make, exponentially raised to the power of time. In this whole equation, the most powerful variable is time, because it is raised to the power of. Mathematically, the amount of money you save is not as important, the rate of return is not as important, as much as the number of years for which you can invest. Now, if you start investing at 45 years, and let's say your lifespan is 100 years, the time available to you is 55 years. But if you start investing at 20, as today, because of the interest you've taken, because of the confusion that came in your mind, you have 80 years of time. So the amount of time, the whole game of investing and making money is about time. And you should thank your friend who, sowed this thought in your mind that you should know something about investing.
Yeah, I'll definitely tell him. But the question which comes to my mind is investing. Okay, I got the concept of investing, but where to invest and how to invest? Like, I don't know where should I go right now. If I want to invest some amount of money, where should I go and how do I go about it?
So before I try to give you specific answers, you also said that you googled stuff and you found this person on Twitter who happens to be the president of DSP, and maybe he has all the answers to investing. Obviously, I'll try to answer as many questions I can. However, I advise everyone who wants to invest and who wants to invest right that a very important ingredient for you to be a successful investor is, one, to make effort to learn, but at the same time find a good advisor, and an advisor who can be a coach for you in your whole journey of investing, who can manage your emotions and help you become a better, more disciplined investor. And there are different types of advisors. You have independent financial advisors. You have digital platforms like Grow, who can act as advisors, who can guide you right. So one, start with a good advisor. Two, what is investing all about? Actually, if I were to look at it, let's say you're wearing Adidas shoes, you're using an iPhone mobile or an Apple Watch. We have to spend a lot of money to buy these day-to-day things of our liking, and we love to wear good clothes and spend money, and spending is extremely important because we need to lead a good life. However, companies which make these goods make a lot of money, and investing is actually nothing but owning companies like this and becoming an owner of these companies without running these companies. So in very simplistic terms, when you start investing your money, and I'll explain to you how you invest, where you invest, but when you invest in an asset class called equity, you're basically giving money, you're buying shares of many such companies which are the leaders in their sectors today. And few examples, you are investing in banks, you are investing in companies which are making cars and two-wheelers, you are investing in companies which make cement, invest in companies which make day-to-day items of use. And as we purchase more and more of them, these companies' profits keep going up. So if you become a shareholder of these companies, the value of these shares go up because the profits of these companies go up. So by investing, what you're actually doing is you're becoming a businessman without taking the worries and the stress and the risk of how businesses work. You're partnering with the best of entrepreneurs in India and the world, and as they make money, you're getting a share of that money by becoming an equity investor. So that is a concept called equity investing. So when you invest in equity funds, you actually become a partner to the best business owners in the world, in the country, and grow when their profits grow and their stock prices go up. The second question was, when do you invest? You can invest only when you have money, right? So as and when you have money, we are all, let's say, salaried employees. We earn money every month, and a very important principle that very early in life, if you are able to inculcate, which is keeping a certain money aside, come what may, as your savings, which goes into investments every month, and whatever is left out of it is what you use for your expenses. Many times, people who have no control of their life or no control of their money end up spending money first, and then they realize nothing is left in hand. In very disciplined investors, the cause of their success is the formula that whatever they earn, they first keep some money aside as savings and investing, and whatever is left, they manage their expenses within that. So the first principle is save money as and when you earn money, and then invest that money after understanding where to invest and how to invest. So the answer to when to invest is every month. The answer to when to invest is every time you have free money coming into your account. When to invest is if someone gives you, gifts as cash and you get money in your account, don't let it stay idle in your bank account. Money staying idle in bank account earns 3.5%, 4% returns. But when you invest in businesses, in funds, in debt or equity funds, your returns grow at a higher rate, and it helps you accumulate your savings and grow your savings over time.
Okay. I also have heard something about debt. So I don't make out the difference between equity and debt and what would be right for me, because being a new investor, I have no clue. Since you have told me about equity, I would also like to know more about debt and how these two differ and which one would be good for me.
So yeah, while I said equity is simple, but many times there are too many choices, and choices are good for us, but choices also confuse us. Yes. So when you invest in banks, when you keep money in a bank account or in a bank deposit, you are actually giving a loan to the bank. And that is basically debt investing. So you get a certain fixed rate of return. Whatever happens to the profitability of that bank or to the stock price of that bank. Independent of that, you get a certain rate of return. When every month you earn your salary, some money is deducted and put in a provident fund. The government gives a certain fixed rate of return. So these type of investments are debt investments where your rate of return is pre-decided, and you are told that this is the rate of return that you will make. So for example, fixed deposits today offer 6% return. Provident fund products, Government of India products offer around 7% rate of return. So you have certainty that if you stay invested for that predefined time of 3 years or 5 years or 10 years, you will get a certain percentage of return. So debt investing gives you a higher awareness and visibility or certainty of return. On the other hand, equity investment does not have this certainty of return. It fluctuates. It can move up and down. So there are years when equity funds and stock prices of good companies fluctuate a lot. They can go up by 30-40%, they can go down by 30-40%. But over a long period of 5, 10, 20, 30 years, they generally in the past have seen to be compounding at returns which are 2 to 3 times of what debt returns are. Now the question is, if debt gives X and if equity gives more than X, why should equity give more than X? Basically, equity has fluctuations. To compensate you for that fluctuation, it has to offer a higher rate of return. And equity returns are an outcome of the profitability of companies. Companies also raise money, companies also borrow money through debt. And let's say if a company borrows money through debt at 7% rate of return, it uses this money and puts it in business and creates products and sells these products. And it has to obviously earn more than the 7%. Otherwise, it cannot survive, because if it is borrowing at 7% and earning less than 7%, it's running a negative mismatch. So companies which generally survive and are good companies, their return on capital, and capital means debt and equity capital, the return on capital is always higher than the return they pay on debt. So as an investor, you have a choice to invest in the same company by either giving them money as debt or giving them money as equity. So these are two different types of capital that companies raise. Return on debt is lesser, but the fluctuations on debt is also much lesser. Return on equity is generally higher, and the fluctuation is also higher. Most investors like to prefer debt because the certainty is high. In the short term, debt has very high certainty. In the long term, equity also has certainty. And equity gives you higher return to compensate you for the fluctuations. As an investor, many investors worry about fluctuations, and there are ways in which this fluctuation can be handled. One way of handling this fluctuation is to take advantage of these fluctuations. So actually there are two ways to take advantage of these fluctuations which equity prices offer. One way is through a concept called asset allocation. The other way is through a concept called systematic investment plan. So I'll explain systematic investment plan first to you. Every month when you have money, you invest that money in an SIP, a systematic investment plan of any equity fund. So what you're doing is you're buying, let's assume you have 2,000 rupees every month. You'll invest these 2,000 rupees in an SIP. The value of this SIP, the value of these units keeps changing in line with the stock prices of the equity market. These values will go up in few months, and they'll go down in few months. When the value goes up, for your 2,000 rupees, you will get X number of units. When the value goes down, for the same 2,000 rupees, you'll actually get more number of units. So wise investors feel very excited when the values go down. For them, this is like the great Indian sale that an Amazon or a Flipkart announced, because it's like sale. Prices go down, you get more units. So the beauty of an SIP is to make these fluctuations work in your favor. And if you do this over 15, 20 years, in 20 years, generally equity prices always go up. There are periods in between when they go down, and SIP allows you to buy more units. And
can I have a SIP amount varying every month?
You can, but the variation can make it a bit complex. What we advise investors like you is to say that, generally every month the salary you earn is fixed, Your expenses are broadly fixed. So what is left is also fixed. So you invest that fixed amount, and every year we get certain increments in our company. Likewise, we should give the same increment to our SIP also. So if you get a 20% increment every year, on your SIP of 2,000 rupees, you should give it the same 20% increment. So there's a concept called top-up SIP. So you should start investing through a top-up SIP. So in the first year, you started with a 2,000 rupee per month, and if you top it up by 10%, for example, in the next year, your monthly installment will become 2,200. In the third year, it will become 2,500. So what happens is, as you progress in your career, as you start earning more money, the higher money starts getting invested through an SIP.
So I heard you speak about asset allocation. I've heard about equity and debt earlier, though I didn't know the meaning. And thanks to you, now I know it. Can you throw some light on asset allocation, because it sounds too complicated to me?
Asset allocation is nothing but teamwork. I explained to you the stability of debt, the close to certain returns of debt, yet the opportunity to earn higher returns in equity with more fluctuations. So if you bring these two together, what it does, what asset allocation helps, is in minimizing the fluctuations of equity, and it helps investors remain focused in their life, doing their jobs and earning more money, rather than get worried with fluctuations in asset classes. So debt and equity are two asset classes. They have their own cycles, they have their own fluctuations, ups and downs, volatility. But when you mix them together, they most often move in opposite directions. So there are times when debt does not give very high return, equity may give higher returns. There are times when equity falls, when 100 rupees can become 80 rupees, but the debt component keeps growing at a steady rate. So in a very, very simplistic way, it is like the hare and the tortoise story, where hare can be someone who runs faster, but can have fluctuations. Debt is like a tortoise, who will move slowly, but certainly will reach the end game. So when you blend the two together, that concept is called asset allocation. If I have to give an analogy, a slightly wider analogy, look at cricket. A cricket team has 11 players. Each player is good for something. So you will have a great opener, you will have a great wicketkeeper, you will have a great captain, you will have someone who is the best in slog overs, there will be a very good spinner, there will be a very good pace bowler. So you have diverse skills and diverse results that each skill can produce. Now, no captain in a cricket team will have a team where the best batsman is replicated 11 times, even though the best batsmen can score 100 runs in every match. So a captain doesn't think that if I have 11 great batsmen, I will score 1100 runs in the match and then win. Because when you bowl, you also need great bowlers and fielders to take wickets. So you build a team of diverse skill sets. Asset allocation respects that concept of diversity and taking advantage of different outcomes from different asset classes. And while right now we are speaking about debt and equity as two asset classes, there are slightly more number of asset classes like gold, like commodities, like international stocks, like real estate. So when you mix these asset classes together in a portfolio, they work together to give you a very good result in your investing journey. Number two, as human beings, we don't like fluctuations. We don't like things going up and down. But markets don't bother about what we like or what we don't like. So they have a mind of their own. There are times they go up, there are times they go down. And when fluctuations increase, we as human beings and investors start getting nervous. And when we get nervous, we react adversely with our money. We start getting fidgety with our money. We don't let it stay invested for long. So for example, you started after talking to a good advisor, you said that okay, I will start a 30-year investment, I will start a long-term SIP. But in the third year, if the value of your investment fluctuates or goes down, you'll feel nervous and you might decide that let me take it out. And many investors end up making that mistake. The beauty of asset allocation, especially dynamic asset allocation, which shifts money between equity and debt depending on which asset class is safer or has more attractive value, is that it minimizes or reduces these fluctuations.